The Federal Reserve rarely tells the whole story, not because they're hiding secrets in smoke filled rooms, but because their job isn't to tell you the truth. Their job is to prevent panic, to stabilize expectations, to guide behavior. But when you look beneath the carefully crafted statements, the polished press conferences, and the selective data, a very different picture emerges. A picture of an economy stretched thin, a financial system under growing pressure, and a future that looks nothing like the Fed publicly describes. Today, we're breaking down what the Federal Reserve isn't telling you about 2025, the risks they won't mention, the challenges they can't solve, and the shift they quietly see coming. This is Mind Over Markets, where clarity meets a changing economy. The Federal Reserve never says things outright. They speak in signals, hints, and carefully chosen phrases. When Powell says, data dependent, it means they have no clear direction. When he says, soft landing, it means they hope for the best. When he says, inflation is cooling, it means prices stopped exploding, but they remain painfully high. The Fed uses language to shape behavior, but language also hides reality. So, what is the Fed not saying publicly? Three big things. One, inflation is far from over. They won't say it, but they know the second wave is already here. Two, rates cannot return to zero. The entire financial system was built on cheap money. That era is gone. Three, the economy is more fragile than they admit. Consumer debt, corporate strain, and government deficits are reaching breaking points. Most people hear the Fed and think everything is under control, but the Fed is managing expectations, not telling the full truth. To understand what the Fed really anticipates for 2025, we need to break down the economic forces they're facing and the ones they won't talk about openly. The Federal Reserve has a dual mandate: 1, keep inflation stable; 2, maximize employment. But in 2025, these two goals are in direct conflict. Here's why. Inflation is still too high. Even if inflation drops to 3%, it's still above the Fed's target. And because wages didn't keep up, families feel poorer. Unemployment must rise to control inflation. The Fed won't say this loudly, but their models require some job loss to slow down demand. Debt is too high to tolerate a recession. Rising unemployment triggers defaults. Defaults trigger banking stress, and banking stress triggers financial instability. Politicians want growth. Election cycles pressure the Fed to keep the economy feeling healthy. Markets want lower rates. Lower rates equals higher stock prices, but lower rates equals higher inflation. The Fed is trapped. They cannot raise rates without hurting the economy or cut rates without reigniting inflation. This is the quiet dilemma shaping everything the Fed does, and it sets the stage for 2025. Publicly, the Fed says inflation is cooling, but privately, they know the biggest inflation pressures are structural and not going away. Here's what the Fed isn't telling you. 1. Housing inflation is permanent. Shelter accounts for 34% of CPI, and shelter inflation follows actual rents with a 12 to 18-month delay. Rents surged in 2022 to 2023. Those increases are still working through the system. The Fed knows shelter inflation will stay high well into 2025. 2. Insurance inflation is exploding. Home, auto, and health insurance are rising at their fastest rates in history. These costs don't go down, ever. The Fed rarely mentions this because it's outside their control. 3. Energy volatility is the new normal. Geopolitics, supply constraints, underinvestment, global fragmentation. Energy shocks will be frequent. Energy drives everything. Inflation will remain sticky. 4. Labor costs are pushing prices up. Workers are demanding higher wages, and businesses are raising prices to compensate. But wage inflation doesn't unwind easily. 5. Core inflation is still above target. Even when the headline inflation cools, core inflation, the type that sticks, remains elevated. The Fed knows this. They just choose softer language. Inflation is not defeated, it's mutating. 2025 will not be the return to normal people expect. This is one of the biggest truths the Fed will never say publicly. The age of near zero interest rates is over. Why? Because 1. Zero rates caused asset bubbles, stocks, housing, crypto, tech valuations. Everything inflated unnaturally, so the Fed cannot go back without recreating the same bubbles. 2. Zero rate caused inequality to explode. Low rates made the rich richer and the poor couldn't keep up. The Fed is under political pressure to avoid repeating that. 3. Zero rates allowed governments to borrow endlessly. Now government debt is so large that returning to zero would ignite runaway inflation. 4. Zero rates distort market behavior. Investors take bigger risks, businesses borrow too much, and consumers overspend, making the economy fragile. 5. Zero rates remove the Fed's ability to save the system. If rates are already near zero, they can't cut them during crisis. This is why the Fed needs rates to stay higher, to create room for future cuts. So when people expect 2%, 1%, or 0% again, the Fed quietly knows those days are gone and probably forever. The data looks strong on the surface. Low unemployment, decent GDP, rising wages, stable markets. But under the surface, the Fed sees the cracks. Let's expose them. 1. The consumer is out of money. Savings are at historic lows. Debt is at historic highs, and people are surviving on credit cards, buy now, pay later, auto loans, and high interest personal loans. This is not sustainable. 2. Delinquencies are rising fast. Auto loans, credit cards, small business loans. This is the early signal the Fed watches closely, but rarely mentions publicly. 3. Corporate debt is a time bomb. Companies binged on cheap debt for 15 years. Now that debt is rolling over at higher rates and many won't survive the refinancing shock. 4. Commercial real estate is cracking. Offices empty, retail dying, refinancing impossible. Banks are exposed, and the Fed knows this risk is huge. 5. Job market strength is artificial. Many jobs created in the last 2 years are part time, temporary, low wage, or multiple job workers counted twice. The Fed understands this nuance, the public does not. 6. Bank fragility is still real. We had bank failures in 2023. More banks are quietly on watch lists. The Fed will never say it, but they know the system is vulnerable. The Federal Reserve isn't predicting a crash, they're preparing for a slow grind. Here's their real strategy, the one between the lines. 1. Keep rates higher for longer. This slows the economy just enough to cool inflation, but not enough to break the system. 2. Allow controlled weakness in the job market. They won't say, we need higher unemployment, but that's exactly what their models require. 3. Engineer a slowdown, not a recession. The Fed hopes to cool demand, reduce excess spending, stabilize wages, and prevent asset bubbles. This is the soft landing dream. 4. Avoid aggressive rate cuts. Cut too fast. Inflation returns, cut too slow. Economy cracks. This is a delicate balance. 5. Prevent financial contagion. If banks or major corporations show stress, the Fed will step in quickly, quietly. 6. Let the economy reset. This is key. The Fed knows the economy needs a reset in asset prices, in corporate debt, in consumer spending, and in government deficits. 2025 will be the year of quiet restructuring, not collapse, not boom, restructuring. What the Fed does and doesn't say affects your income, investments, housing, savings, job security, retirement, and opportunities. Here's what their 2025 path means for you. 1. Borrowing will stay expensive. Mortgages, auto loans, credit cards, business loans. Don't expect relief. 2. Housing will stay stagnant. High rates freeze the market. Prices won't crash dramatically, but they won't rise fast either. 3. Stocks will be volatile. No more easy bull markets. Expect turbulence. 4. Recession risk will remain elevated. A slowdown is inevitable. The only question is how deep it goes. 5. Savings become more valuable. High yield accounts give real returns. Cash is power in uncertain times. 6. Skills become more important than ever. The job market will shift. AI and automation will accelerate. The Fed can't save jobs, only workers can. 7. There will be opportunity if you're ready. Every slowdown creates undervalued assets, cheaper investments, new business openings, talent shortages, and innovation waves, but only for those who prepare early. Here's how to stay ahead of the Fed's quiet 2025 playbook. 1. Build a strong cash position. This protects you and positions you for opportunity. 2. Eliminate high interest debt. Rates won't drop soon. Cut debt aggressively. 3. Strengthen your skills, especially AI literacy, data, finance, communication, analytical thinking, and digital income streams. 4. Invest steadily and patiently. Volatility is opportunity. Don't chase hype, accumulate value. 5. Be cautious with housing. Only buy if the math works. You plan to stay long term or you're financially stable. 6. Watch the job market closely. Signs of stress appear before recessions hit. 7. Protect your time and mental health. Uncertainty creates anxiety. Clarity reduces fear. Preparedness creates confidence. The Federal Reserve won't tell you everything. They can't. If they did, markets would panic, businesses would freeze, and the economy would unravel. But by reading between the lines, by understanding the cycle, the pressure, and the quiet signals, you can see what's really coming. 2025 won't be a year of collapse. It will be a year of transition, a year of recalibration, a year of opportunity for those who understand the game. Stay sharp, stay informed, stay ahead.